So with that, we'd like to go ahead and move on to Q&A. It looks like we have some questions here. Just as a reminder, feel free to send over questions. There's a Q&A chat function in the webinar, so you can send in questions and we'll try to get to them. But first, David, let's start with this question. I figured this would be good for you. We got a question. So how has the decline in labor market participation impacted, the overall unemployment rate?
Sure. So just to start off, so labor force participation is the number of people in a given population who are either employed or unemployed. And so unemployed requires you to be actively looking for a job. And so declines in labor force participation are an indication that people are unemployed and they aren't actively looking. And we have seen declines during the pandemic, similar to what we saw during the financial crisis. So I think there are a couple of narratives for why we may be seeing that. One is that people are they're losing their job at the end of their working life, and they're just sort of deciding, well, I'm just going to go ahead and retire instead of actively looking for new work. Another is that people are just discouraged. They don't feel like there's a job out there for them. That would be somewhat at odds with what we've seen from surveys of some businesses, which indicate they're looking for qualified labor and they're having a hard time finding it. So we have seen that decline. Now, for how that affects the overall unemployment rate. So the U3 rate, which is the headline that is often quoted in the financial media. So if you are not participating in the labor market, you're not going to be included in the U3 rate. That's one of the reasons why I think the U6 rate is perhaps a better measure of the overall level of slack. And so as we bring down the U6 rate, which includes people who would like to have a job but just aren't making the effort to go out and actively look for one, those are people who are potentially able. That's additional slack that's not being represented in the U3 rate, and that bringing that level down is an important goal of monetary policymakers and the federal government.
Great. And I guess just kind of keeping on this topic, I mean, what are your thoughts of the proposed increase to minimum wage? I mean, and how does that affect, unemployment or, job growth moving forward?
Yeah, sure. So the increase in the minimum wage is something that's always controversial whenever it sort of comes up to the surface of the political discussion. So what's being discussed right now is an increase in the federal minimum wage to $15 in sort of annual increments up to 2025. So it's a gradual increase to that $15 level, but it would be a substantial change for millions of Americans. Because this is proposed legislation, it's something that gets scored by the Congressional Budget Office. And so we have some pretty reliable data, I think, about the potential impacts of this increase. And no surprise, I mean, there are winners and losers. There are people who would lose their job because at this federal this level of minimum wage, where they wouldn't be providing the value that would justify their employment. And so the CBO expects that we could see 1.4 million workers lose their job under this legislation. But on the other hand, there are people who certainly would be winners of this. Those are people who are being paid below that $15 level today, who would see an increase in their wages. The estimates by the CBO are that we could see almost a million people lifted out of poverty by the passage of this legislation. Cumulatively, we would see perhaps pay for not just people who are below that $15 level now, but people who are perhaps just above it. There's quite a wide range on the wage spectrum who would see a change in their wages from an increase in the minimum wage. We could see overall cumulative pay increase by $330 billion over the next decade should this legislation come to pass. And so that's a pretty significant increase in spending capacity in the economy. And then finally, the spending bill doesn't have a significant impact on the debt and the deficit. I mean, for the people who do lose their job, we would expect that there's going to be some additional unemployment benefits paid to them, but the overall impact on the debt and deficit is small. The CBO estimates that over the next decade, the federal budget deficit would only increase by $54 billion. That's a pretty small increase over a 10-year period. So, I mean, this is a discussion that economics is not particularly good at handling. It's something that is a political process that will work out. There are certainly winners and losers, but there are, that's a political discussion that ends up taking place over whose priority should be put ahead of who else's. So I would say that from an economic perspective, it doesn't have a big impact on the debt and deficit. It would have a marginal positive impact on overall consumer spending.
Okay, thanks, David. Sticking with you, got another question for you as well. I mean, a topic that's been discussed lately on financial media and among market participants is, whether or not the proposed stimulus recovery plan is really necessary, just given, some of the signs of improvement we're already seeing. Can you maybe give us your views on that?
So as to whether or not it's necessary, I think the shortest answer is no. I mean, we looked at the CBO's estimates of the output gap, and we do see that the output gap should close over the next 5 years. But there is potential through additional stimulus that we could close that output gap faster. And as I said, the 1.9 trillion, I don't think that the end amount that passes into law will be quite that high. I do think it'll be somewhat lower than that. But it's important to remember that in that amount, it's not just all stimulus. There's some of that is continued economic relief for the nearly 20 million people who remain unemployed. And so sort of those that sort of spending can actually be considered more like relief, continued relief for those who are affected by the pandemic in terms of their employment status. And then finally, for the remaining portion that actually is stimulus, one thing that people I think should keep in mind is that $1 of stimulus doesn't translate one for one into $1 of economic output. There is something lost. Estimates during the pandemic suggest that $1 stimulus has turned into about 60 cents of additional economic output. So those are all things to keep in mind. It is not necessary, but I think additional stimulus does bring forward the time when the economy will be back to sort of firing on all cylinders, and we can get people back to work and consumer spending as they normally would.
Thanks, David. All right, Jeff, I think I'm going to mix a couple of questions here that we're getting from some of the attendees. And I think, I think it goes back to what you're pointing out. Valuations seem stretched. A lot of stocks have surpassed, pre-COVID levels, but there's also a lot of companies out there that, have been impacted more severely by COVID that, haven't seen their share prices return to levels such as, hospitality, entertainment industries, or, maybe large construction firms, industrial firms. Eventually between immunity and vaccines, how quickly do you think that some of these stocks could come back? Like for example, like travel and hospitality, and how are we viewing that? Are we looking for opportunities to participate in that rebound?
Yeah, no, it's a great question. We do, it somewhat goes to the value versus growth debate out there. But I think you need to look at it a little more granularly in the fact that, there's going to be some winners and there's going to be some people that just, aren't able to recover from the downturn that's occurred. But as we do start to open up, I think, as David kind of pointed out in his, presentation, spending on services has been really depressed and continues to be depressed. And it's likely that, we're going to see people want to get out to restaurants, and we want to get back to traveling. We want to get out and utilize some of the stuff that, it returns life back to the normalcy it was before this whole pandemic. And the way we're definitely looking at names in those areas and who will benefit from those. But I think it's going to be a process. And, David has talked about this in the past, that, I think that people are going to, step out, maybe be more comfortable going to their, restaurants first before they're going to be comfortable with jumping on an international flight. It might be that they're more comfortable doing domestic travel before international. And then it might be, further down the road that, people finally get comfortable enough to jump back on a cruise ship. So I think you have to look at, how the cadence of this reopening and the spending is going to occur. But going back to, the excess savings that's occurred out there, I think there is probably more positive surprises that are going to occur over the next year with respect to a lot of these companies, and we start reopening. I mean, I just anecdotally, I know a lot of people that I've talked to just can't wait to get out and travel again, and can't wait to get out and have more of the social interaction. And so I think that there is a lot of pent up demand. I also think that there is the resources to do it. It's just, I think it's all going to be key on the vaccination schedule. But, I think it is a great question that even though the market's at all-time highs, there's definitely some stocks out there that are still, very cheap when you look at it from more of a normalized operating environment. It's just kind of going through those names and making sure that you have a company that has the financial resources to weather kind of this drought that we're currently in with them, and then able to capitalize on the recovery once it does, I guess, take hold in earnest.
Sounds good. And it looks like we're getting close to the end here, but we got one more question I'd like to ask. I'd like to put to you, Jeff, more on the fixed income side. So yeah, obviously, given low interest rates, overpriced bonds, other economic uncertainty, high equity valuations, how are we thinking about preserving capital for those that may be more risk averse or, are looking for more income? Are we thinking about preferreds, munis, or how do we think about preserving capital, just given the environment we're in?
No, absolutely. Now, here, I said earlier, this is really a tough market to be in on the fixed income. Earlier last year, we were really excited about preferred stocks. They really got thrown out to the woodshed. The interest rates on those were really high relative to the market. But going back to our seesaw analogy, I think you have to understand the length of maturity of a bond kind of moves you out from the pivot, the fulcrum on the seesaw. So stuff that is short term in maturity, kind of really close to the fulcrum. So when the stock market, or I'm sorry, the interest rates move, the price of the bonds and the securities don't move. Now, preferreds, depending on the call structure on them, a lot of them are callable, but depending on the call structure on them, they can be very long dated. And so I think you have to be somewhat careful on the ones that you buy there. And I know we look at, certain types of preferreds that have closer call schedules. So they're not sitting way out on that seesaw. So when you see interest rates start to move, you get, more dramatic of price movements. It is one of the reasons that we are a little bit more positive on, the high yield. High yield tends, as I said earlier, tends to be shorter in its maturity length. And so here again, that means it's sitting closer to that fulcrum. And so as interest rates move up and down, those bond prices won't be moving as dramatically as stuff that's further out on the maturity spectrum. That coupled with a recovering economy, investing in a high yield basket of securities, I think, is probably one of the better choices. The other choice too is, just as to assume that, interest rates are going up, you just invest in shorter term bonds, and you might have to give up, some interest for the next 1, 2, 3 years. But as those, securities mature, you're going to be able to roll those over and hopefully into higher paying interest rates. Now, the problem with that is I don't think anybody's anticipating interest rates are going to be going back up on the Treasury to 4, 5, 6%. So we might just be stuck in a low interest rate environment. Furthermore, if inflation does pick up, locking in interest rates in a fixed income environment, it's a fixed payment stream. And so those payments lose their purchasing power, and that's one of the reasons that we're a little more positive here again on dividend paying stocks. A little riskier, but dividends normally increase every year, and so if inflation picks up, you're not necessarily locked in on a fixed income stream, but one of which that can grow along with the economy. So it is a very, very hard environment. You have to really balance your risk return on there. And unfortunately, the returns are really paltry right now. So again, I would just caution you not to invest really far out on the maturity spectrum right now, just because jumping for yield by going out and investing long term is just locking you in on these low interest rates.
Thanks, Jeff. So unfortunately, it looks like we're out of time here. I apologize for not being able to get to every single question, but I'd like to thank both David and Jeff for providing their views on the economy and markets. Just to remind you guys, we did record this this video, so we plan on making it available on our website within the next couple of days. So if you guys have any other questions, comments, or suggestions for future presentations, and we would encourage you to contact your portfolio manager or business development manager. And with that being said, thank you for attending. We hope you have a great day.